Good morning. Welcome to our regular second Saturday webinar. We will start the presentation now. If you see in the last 1 month, Nifty tried to touch the 20,000 mark, but could not be able to touch it. It went up to 19,992, just 8 points away from the psychological level of 20,000 points, but retraced now. It looks like market maybe remain range bound in near term, may see some sideways movement also in many stocks. Global markets also, if you see, there is not much action. So from Monday, the earnings season will come to an end, and after that, there will not be much news to drive the market. So for near term, we expect market to remain range bound, and we will see only stock and sector specific action. In the last 1 month, if you see, there was plenty of stock and sector specific action was there, especially sectors like pharma did well, and many stocks in mid and small caps, they did exceedingly well. And if you see the Nifty and Sensex, it was just flat in the last 1 month. Though the Nifty touched 19,992, from there it has corrected to the levels which was seen in the last month. So virtually Nifty and Sensex were flat in the last 1 month. After going up, it has corrected back. Whereas mid and small cap did very well. Mid cap index is up by almost 5% and small cap around 6.5%. And everyone was talking about US recession and European recession for the last so many months. One interesting thing happening on the world second largest economy is China, where the most of the data points coming from China indicates there is a sharp slowdown in China. If global economy slows, that slowdown also will get added to China, because China is the world manufacturing hub. And if global demands are lower, naturally China production demand also will be lower. So coupled with domestic slowdown and global slowdown, China is struggling down. Whatever data point you look like PMI data, export-import data, and real estate data in China, there is some big slowdown happening in China. FPI last many months, we have from April onwards, there was strong inflow, but for the last 2-3 weeks, there was considerable slowdown in foreign institutional flows. And even yesterday, they have sold it. And previously, they were selling like 500 crores, 600 crores like that. But yesterday, there was sharp selling from foreign institutions. So till April, May, June, we saw good inflows. But from second half of July onwards, foreign institutional flow also has dried. On positive side, the monsoon has picked up in July. June was below normal month, whereas July we got surplus rain throughout India, except in packets of Himalayan, sub-Himalayan parts like UP, Bihar, like that, where the rainfall was shortage is there. On south, only Kerala was highly deficient. Otherwise, if you see, most of the parts in July throughout India, there was a very good rainfall was there. So overall, Nifty and Sensex was flat, whereas mid and small, there was a big action was happening in the last 1 month. So China, the data point, if you see like PMI data, then export-import data, and other real estate sector data, whatever macro data that is coming out of China, it indicates that there is a big slowdown happening in China. China is the biggest consumer of most of the commodities. If you see steel, base metals like copper, zinc, and even many other commodities, China is the biggest consumer. So if any slowdown happens in China, means naturally that has to get affected. Theoretically, since they are the biggest consumer, theoretically the commodity price has to correct if China slowdown sustains. We have to see how it is going to pan out in coming months. Whether government may try to give some stimulus to the economy, that has to be watched. Till now, commodities are holding very steady in spite of slowdown happening in China. Also, China is the second largest economy in the world, and any slowdown in China will impact global growth also. China is the manufacturing hub of the world. So part of the China slowdown is attributed to the global slowdown. Because of that also China is slowing down. Coupled with the domestic real estate issues, Chinese economy has slowed down. The impact, if you see on India, the first casualty was the chemical companies we have seen. If you see the last quarter results, that is Q1 results, which has come now recently, most of the chemical companies posted very bad results. Some of the basic chemical company posted extremely poor results. For example, Gujarat Alkalis, which manufacture caustic soda and some other basic chemicals. If you see last year, same time, they posted huge profit, but this time they showed a loss, mainly because China, due to less demand on their market, on the domestic market, they started dumping heavily throughout the world. The impact is chemical prices has collapsed, and even some of the chemical price has come down by 30%, 40% in the matter of few weeks. And companies manufacturing this chemical, their profitability also has impacted. One positive point is that after falling very sharply, now prices are stabilized and some small rebound started happening in the last 2-3 weeks. And the China plus one theme, where most of the stories were built, that European and US buyers will prefer, apart from China, some other countries where they will start buying. Chemical was one of the biggest stories which was marketed based on China plus one theme. And if you see the casualty, now it was the first to fall in the current market, where the most of the chemical company, the profitability has come down. China plus theme, not only chemicals, many other sectors were also marketed, like textiles, also told that India will benefit from China plus one theme. We have to see how it pans out. It all depends upon how Chinese economy will do in coming months. This is the world top 10 economies. And if you see that, USA is the world largest economy with 26 trillion GDP size. The second one is China with 19. The third one, Japan, which is far away from the number one and number two size, with just 4 trillion. So Japan, Germany, India are 4 and 3.75. So any slowdown happening on the two economies, that is USA and China, it will have impact on the global economy, because these two economy they have huge size among all countries in the world. And China with 19 trillion GDP size, any slowdown happens means then definitely it will have an impact on global growth also. And if you see the GDP per capita, if you see, India is the fifth largest economy with 3.75 trillion. And if you see our GDP per capita is just 2.6. Fraction to that of what USA is. So if you see this table, for India to do very well, our GDP per capita has to go up. Then only we can do it. If you attend any big company's presentation, they will always tell that for example, if you attend a steel company making presentation, they will tell that our per capita consumption of steel is one of the lowest in the world, and when compared to USA, it is just a fraction. Even when compared to China, or even when compared to Brazil, it is less. So there's a huge scope for India doing well. For that, per capita income has to go up. Then only our people will have spending capacity, they will buy more. India has huge population, but our GDP size is relatively small when compared to the size of the population. That's what it indicates. GDP per capita is very low, just 2.6 thousand US dollars. Whereas even if you see the Brazil, it is around 9.6, whereas USA it is 80, China 13.7. Still a long way for India to go up. And once it starts growing, means even if it goes up by double or triple, the consumption will go up very sharply. one interesting thing happened in the last 1 week is that Morgan Stanley has upgraded India in their portfolio to overweight. As I said, China was slowing down. They have downgraded China to equal weight because the economic data coming from China is very from China is not good. Even PMI data is less than 50, which indicates a big slowdown in China. So that's why they have downgraded China to equal weight, whereas they have upgraded India to overweight. Many reasons they have told it. One of the reasons they have told it was that India has secular growth story for the next many years. That is why they have upgraded India to overweight. And many charts they have put in their report, and some of them I will show it now. What they are saying is that India is very less leverage in private sector. See, in debt market, there are two of them who used to borrow. One is the government who used to borrow heavily. In India, government is one of the biggest borrower because India has almost 15 lakh crore of fiscal deficit, and government used to borrow that 15 lakh crore mostly from domestic market only, from banks and insurance companies through issuance of bond. Whereas if you see in private sector, which consists of household debt as well as corporate debt, if you see that when compared to many big economy, we are one of the least. So that is one positive they are telling, because people has can take leverage and spend money, which means that economy will grow in coming years. That's what they are mentioning. And if you see that household debt to GDP, if you see, India is just 19% of household debt when compared to the GDP size. But if you see, Australia is more than 100. Australia, Korea, more than 100. Even some of the Asian countries like Taiwan is near to 100. Taiwan, Thailand, they are all very highly debted. Household debt is very high, more than 80%. Japan 65. China, if you see, almost 50% of the GDP size household debt is there. That's why they are telling that India household debt is very less, which means that household can take more debt when compared to their size, and which means that more debt means more spending power, and which means that economy will do well. That is what they are telling. Similarly, non-financial corporate debt, if you see that China is almost 182%, which means that their Chinese companies leveraged and they have huge debt. That's what they are telling. Korea, Japan, Taiwan, Thailand, all these Asian countries, all of them has more than 100% of corporate debt to GDP ratio, which means that they are highly leveraged. When compared to India, is just 51%, which means that corporate debt is extremely low in our country when compared to most of the Asian countries, and company can take debt and can expand. That's what they are telling, that India is a multi-year secular story and India can do well. And this is one of the interesting chart where in the last 1 year, if you see that bank credit growth, if you see that industrial growth actually has come down in the last 1 year in spite of strong credit growth. This is mainly because most of the company balance sheet are extremely strong. Their debt equity ratio is very less. Many big companies, they are debt free. Many manufacturing companies, they are even debt free, which means that they can borrow money and can build manufacturing plants. That's what it indicates. And the services sector, the debt level has gone up from 12 to 26. Personal loans from 18% growth last year. This year 20% growth is there. Agriculture from 12 to 19. So overall, the industrial credit growth is still very anemic when compared to other sector. Also, another interesting chart, Morgan Stanley, in their research report, they have mentioned is that the working age population in India is consistently going up. If you see that from 1990 onwards, till now it has consistently gone up. And for the next 8 years also, they are expecting that working age population will continue to increase in a linear manner. Whereas if you see China, it was increasing from 1992 till 2010, and it has got plateaued out. and in fact, it started coming down. For an economy to do very well, the working age population should be there, because this is the population which contribute most to the economy. They earn money, they spend money, and when you get old, means what will happen? You will remain inside the house, and the spending of money will be lesser, and it will not contribute much to the economy. So the big worry in China is that the working age population has saturated 7-8 years back, and it will continue to do so in coming years, at least till 2030. Whereas for India, the working age population, which will be around just about 20 and less than 60 years, that is the main population which are in the working age group, and this is the group which contributes most to the economy. And for India, it is going to be a linear upside, which means that they will continue to contribute more to the economy. ROE comparison, if you see China, Taiwan, and India, if you see that India always used to have higher valuation when compared to other countries. One of the reason it is that our ROE is slightly higher when compared to other countries. When compared to China, if you see, China ROE has come down in the last 2 years, whereas for India, the ROE has gone up. Once the company capacity utilization goes up, means again the ROE will go up. Inflation, if you see, where globally, when every central bank was hiking interest rate, China is cutting interest rate, because their inflation is very less. So inflation will come down for 2 reasons. One is that if production is more, inflation will come down. Second, if economy is very weak, means consumption is very weak, means similarly inflation can come down. So that is why the China inflation is very less. Even the last print of CPI data came from China is actually negative. In the chart that is not included, 2 days back Chinese inflation data came, which came into negative, which means that the deflation is there in China, which indicates that Chinese economy is on a very weak. That's what it indicates. Many of them will be knowing that in Japan was struggling with low inflation for many years because of very low consumption and very low economic activity. So now most of the analysts are fearing that the same could happen in China also, because the working age population has saturated, whereas the old people are getting population pie is increasing more, which means that the inflation will remain low in China, just like how Japan was experiencing for last many decades. In my initial remarks, I told that many sectors were doing well in the last 1 month. Among them, one sector which has been doing very well is the pharma sector. I have discussed this many times back, but as a sector wise, we are very positive on pharma sector. The pharma BSE Healthcare Index is at an all-time high and continuously going up. There are many tailwinds in pharma sector, and we will discuss in detail in coming slide. Actually, pharma is a diversified sector, and we should not paint all companies with same brush. We have to see an individual company, their business model, and has to take decision. Basically, there are 4 types of pharma companies, which I have mentioned in the below table, which is the domestic formulation companies, where companies like Mankind, Torrent Pharma, where their most of the business were domestic driven. Pfizer, many MNC companies are there, Pfizer, Sanofi, all these are domestic formulation companies where their business are mostly domestic oriented, and we remain positive on long-term prospects of these companies. The next one is the US generic business, where we are very positive, at least for the next 3 to 6 months basis. We are very positive. After that, how it pans out, then we will see at that point of time, and we'll take the decision. But at least for the next 3 to 6 months, we are very positive on the US generic companies. and some of the companies where the US generic business is more in their overall business are like Dr. Reddy, Aurobindo Pharma, and apart from that, even Cipla, Lupin, Zydus, they have a very big part of their overall revenue comes from US generic business, and we are very positive in this segment of the pharma business. API business, we are neutral because API, some of them are basic of products where there is a prospects of China dumping happening. That is why we are neutral on the API business, and it has to be seen on a company-wise basis, and based on the individual products, we have to take the decision. CDMO, which is companies like Syngene and Newland Lab, where contract development, custom development, and manufacturing used to do on research on individual molecules. That company, we are positive on that. Only thing is that Syngene, the valuation is very, very high. So in all the pharma among all pharma companies, we are very positive on US generic business, at least for the near term, next 3 to 6 months. Even if you see the results of these companies, they are very good, and most of the companies have beaten analyst expectation. This is the S&P BSE Healthcare Index, which is at an all-time high. Actually, for 4 or 5 years, it was not doing well. Now, again, during COVID time, it had a sharp rally. Then it has corrected well, again moving up. Between 2015 to 20, the overall pharma index did very badly. If you see from 2016, the index peaked out, but it bottomed out during COVID time. Then we had a big COVID rally. Then again some correction was there. Now we are seeing that the index has gone up very sharply. So in S&P BSE Healthcare Index, the main contributor weightage company is the Sun Pharma, more than 15% weightage is there. The next one is Divis Lab, which has around 9% weightage. So Sun Pharma and Divis altogether has almost a 25% weightage in BSE Healthcare Index. Then it is followed by Cipla, Dr. Reddy, Zydus. Then some of the hospital companies are there, which has weightage around 5% equally. So the main weightage is Sun Pharma and Divis Lab in BSE Healthcare Index. We expect pharma companies to do well. So I will tell why we are positive on the US generic companies. I will tell now. Actually, US pharma market is one of the largest in the world, and to do business in US, there are a lot of compliance issues are there. You have to follow that. You have to spend a lot of money for R&D. Then only you could be able to do business in US. First, the plant you have to build specifically for US exports, where US FDA will come and inspect the plant, and you have to get approval from them. The plant has to get approval from US FDA, and inspections, US FDA will come for inspections, and inspections are of various types. The first one is the good manufacturing practice. You have to get first to pass through, then only you could be able to export their products. Then you have to submit the ANDA to US FDA, that you have to get approval. Then again, they may come for inspection for individual product specific approvals. They may come for inspections. So all these will cost heavily. You have to spend at least 5 to 8% of your overall revenue for R&D. Then only you could be able to do business in US market. And if you see that some of the companies did very well. But between 2018 and 22, most of the companies faced very tough time, because what happened was that the US FDA plant inspections, they made very strict after 2016, where most of the Indian companies made huge profits from US markets. The plant inspections became very strict, and most of the plant they did not got approval from US FDA. So the companies started suffering from that. And from 2018 to 22, what happened was that the buyers were become concentrated. US the companies which were selling the products, the buyers were become concentrated, because most of them will be knowing that in the US market, all the when you go to hospital without insurance, you cannot have health care there, because the prices were very very high. You cannot afford health care in US without insurance. Insurance. Uh, and these hospitals, they buy their medicine from selected parties, and the buyers become concentrated. And because of buyers become concentrated, what happened was that the prices started falling very sharply. The generic, particularly the generic prices, started falling very sharply, and many companies started making losses in the last 5 years. And because of companies making huge losses, the last 1 to 2 years, many companies were shut down. And because of that, now the competition, buyers were concentrated. Now sellers also has become concentrated now, which means that the price erosion has gone down very sharply in the last 3-4 months. And the sellers also has now got the pricing power now. Previously, in the last 5 years, only buyers had pricing power. Now, because of very less sellers, now sellers also has started getting bargaining power, which means that price erosion was not there now. Also, in the last 2-3 months, if you see that US FDA inspection, which was very harsh previously, they have now turned very soft. They are giving approvals immediately without any form 483 issues. And if you see that many companies, they are getting cleared by US FDA immediately. So that positive has now happened now. Along with that, the price erosion has gone down. The another issue which we are hearing from US is that there is a huge drug shortage in US, because the sellers, most of the companies gone bankrupt. They have closed their plant. The sellers were less now, and they are and because of that, there is a huge drug shortage in US. And because of these issues, we expect that Indian companies which has managed to sail through the tough time of 2018 to 22, and in spite of all the tough times, they continue to spend huge amount for R&D. They are going to see the benefit in coming months. And a new tailwind has come in the last 2-3 months, is that because of China dumping of chemical products, the raw material prices has fell very sharply, and which is a fresh tailwind for the pharmaceutical companies, and that will increase margin for many companies. And in US generics, there are 7-8 big companies are there. Among them, we are positive on Dr. Reddy. We are extremely positive. Zydus Life, we are extremely positive. Lupin is a turnaround candidate, and we expect that also will do well. The other companies like Aurobindo Pharma, because of corporate governance issue, we are not recommending it, but we expect that company also will get benefited. And these companies, if you see, in spite of tough time they faced in the last 4-5 years, they spent a lot of money for R&D, and they are mainly concentrating on a specialty and a complex generics where the competition are less. Even yesterday, I attended the Zydus Life Science board meeting. Yesterday, they came out with their results, and if you see that their profit has gone more than 1,000 crores in the last 1 quarter, which is almost double what they have got in the previous year in the Q1. And when I attended their conference call of Q1, company is very positive. Previously they were telling that they will grow single digit growth in US market. Now they are saying that they will grow in double digit. Also margin, they are expecting 2% higher margin in current year when compared to last year. So with the guidance, the growth they have revised upwards, margin they have revised upwards, which means that at least for the near term, this company will do well. And the fall in raw material prices is a fresh tailwind for them. And similarly, if you see the conference call of Lupin, Dr. Reddy. All these companies were painting a very rosy picture, at least for the near term, and we remain positive. The other big thing is that most of the portfolio managers and even mutual funds and other market players, they are not positive on these US generic companies for last many years, because what happened was that in the last many years where things were looking up, but they will buy it again, some bad news will come from US FDA, then again price will fall. That was happening for the last few years, and that has made most of the fund managers very negative on this US generic space. But now genuinely some big tailwind has happened, which means that the most of the underweight portfolios, they may start buying the US generic companies, and I expect that they will do well. On Q1 earnings, if you see that results were mixed, so it's an eye-opening opener for many analysts, because some of the companies which were given 70 PE, 80 PE, even in some cases 100 PE in chemical companies, if you see the results of chemical companies, their profit has come down in many cases, where the companies were trading at an 80 PE, above 50 PE, many companies were trading. And most of the high value shares, high overvalued shares, their earnings were not as big as it should be compared to their valuations. And it is an eye opener for many analysts, and results were mixed overall. Banks mostly posted inline results, and in the last 1 year, if you see, most of the banks have already discounted the positive results. IT, there was a big disappointment, and many companies fell post the result declaration, and we expect that some value is emerging in IT sector, but still overall the analysts are negative on IT companies. But we expect it's a good time to accumulate at least large cap companies like Infosys and HCL Tech. Even yesterday, HCL Tech has announced one of the biggest order in their history, and even though the IT company results were disappointed, at least a time to gradually buy into large cap IT stocks. Pharma companies, most of the company posted better results. Chemicals, as I said earlier, posted bad results due to dumping from China. And commodities is a mixed results. Jindal Steel and Pipe posted, Jindal Steel and Power posted good results. JSW also posted good results, whereas SAIL and Tata Steel were average. Hindalco also average. So what is going to happen in China, it has to be seen, because it will have an impact on the commodities. And Q1 result performance, this is taken from the Business Standard newspaper. The sales did not went up much, whereas the profit has gone up very sharply among 1,489 companies. The main reason is that the margin is higher. The commodity price has come down, which has improved the margin on most of the companies. Last year, the sales were up because for very high commodity prices, most of the companies hiked their prices, which improved their revenue, particularly the steel companies and commodities company. Similarly, profit also gone up. Whereas now, if you see that revenue is flat, whereas the profitability has gone up, mainly due to the low commodity prices, which has increased the margin. Mutual fund inflows continue to remain steady, around 15,000 crores. The overall SIP contribution is around 15,000 crores. So for the first time, the SIP contribution has crossed 15,000 crores, and which is an perennial source of money for the mutual funds, because even if market goes up or down, the SIP money will continue to get added, and it will keep on growing up, at least for the next many years. The net flows were almost flat, around 7,600 when compared to previous month. Around 7,600 crore was there for the current month. Previous month slightly higher than that, but overall, because of high SIP contribution, the overall net equity inflows will remain positive. So one big study which has come on the mutual fund inflows is that the small cap fund has got most of the amount, almost 15,000 crores. This is for the April, May, June, July 4-month period. This is this data is small cap fund, almost 15,000 crores inflow they have got it. Mid cap fund 6,000 crores. So overall on 25,000 crore, most of the money has come from come into small cap fund and mid cap fund. That's why if you see that the small cap and mid cap index has done relatively well when compared to large cap indices, mainly because the small cap fund and mid cap fund has seen very good inflows, whereas the large cap fund and focused fund has seen maximum outflow in the last 4 months. Even some of the fund like Nippon small cap fund, which is the largest small cap fund in our country, they have stopped accepting lump sum payment in small cap, because what they are telling is that the opportunities are less in small cap, whereas the inflow is very strong, which means that they could not able to deploy the money they are getting into the stocks. That is why they stopped accepting lump sum inflow in the Nippon small cap fund. Even some other funds also, they have stopped inflow into the small cap funds. FPI inflow 18.3 billion for the last 2 weeks. The inflow has stopped, and a small selling as well as some small selling is happening. Yesterday there was some big amount of selling was there, and we expect that FPI flows will not go into much negative now, because most of the institutions were positive, and since the index is slightly at a higher level, the inflows has slowed down. But we expect that once index corrects, then again the foreign inflow will start coming in. Monsoon is good. There are 4 months of monsoon season: June, July, August, September. Till July 31st, which is half of the monsoon season, it was 5% above normal. But in August, if you see, for the last since August, the rainfall has been less. IMD has forecasted that August and September to be normal. Among them, August they are expecting to be just above normal, whereas September to see good rainfall. As per their prediction, for the last 11 days, the rainfall in August has come down. Now what IMD is forecasting is that from August 18 onwards, the monsoon will again start picking up throughout the country, and September will be a good rainfall month. That is what their projection is, and they're expecting overall the monsoon to be normal throughout the for the full season. That is what they are expecting. And this is the rainfall chart since it start. June was very bad. At one point of time, it was -60. Then most of the negative was taken back, and it went to positive for at one point of time. It was even 7% surplus rainfall during the month of July. Now, because of less rainfall for the last 10-12 days, it has come to almost zero. And what is going to happen now is that it may go to -2, 3 like that for the next few more days. And again from August 18th onwards, the rainfall will pick up. And overall, by end of this season, by September 30, it is expected to be a normal monsoon. GST collection consistently going up by 12%, mainly because the inflation is economy is growing around 5 to 6%, and inflation is around 5 to 6%, which means that GST collection is going to be 12% higher than last year, and it will continue like this. US Fed, they have increased in the month of last meeting, they have increased it by 25 basis point. Now the September meeting is that it is expected that they may they may not hike interest rate in the month of September. That is what the expectation is. Now we had a very good rally in mid and small cap. So what investor to do is, what our reading is that our market is unlikely to see major fall. There may be intermediate technical correction will be there. Right now from near to 20,000, market has corrected to around 19,400 levels. What if we are expecting is that maximum market, if correction, technical correction continues, market may fall to 19,000 or 18,900 levels, unlikely to fall below that. And again, it will bounce back. 20,000 is just a matter of time. And among mid and small caps, always be selective, because some of the companies which were trading at very high valuations at 70, 80, 90 PE in many mid and small cap space, the results were not that much great, especially in the mid and small cap defense space and in the chemical space. One has to be very careful, because a lot of narratives and stories has been told in that segment, like there is a huge opportunity like that, and we have to be very careful in that, and always be informed before buying it, because the sharp move has happened in many mid and small cap stocks, and be careful in buying high value stocks, because once when ship turns miss, then it will take many years to get our buy price. So be careful and be selective in buying mid and small cap space, because of euphoric move we have seen in many stocks in the last 3 months. In spite of that, there is still a lot of pockets of opportunities are still available. Reasonably valued stocks are there in the broader market, and take and be selective in buying. That's what we can say. And we are expecting that markets will not fall much. Maximum, if the current sideways continues, it can come to 19,000, 18,900 levels. Beyond that, market unlikely to fall. And Geo is going to be listed very soon. The shares of Geo Financial, the shares have already been credited in individual demat account. We expect that Reliance will show some movement at the time of listing of Geo Financial. Data to watch. Important thing is the monsoon progress we have to see. Then a foreign portfolio investor flows we have to see, because April, May, June until July 15th, good inflow was there. Whereas from third week of July onwards, there has been some slowdown in FPI flows, and that also we have to watch it. Now we will see the recommendations. So these are the 5 stocks we are recommending. The first one is Dr. Reddy's Lab, where I told in about the US generic companies, we are seeing some tailwind happening, and that is why we are positive on Dr. Reddy's Lab. Valuation also reasonably available. The company don't have any debt. They have around 5,000 crores worth of surplus cash they are having their balance sheet, and we are positive on Dr. Reddy's Lab. Infosys, we have recommended previously also. Now post results, the stock has corrected because of the results were not good. But if we expect that the company will do well, and it's a good time to accumulate the IT stock. Nilkamal Plastics, so it's a small cap company where we feel that valuations were reasonable. The company is doing a lot of capex. Last 2 years they have done huge capex. The current year also they are. In the current year also, they are planning for a very good capex. We expect that the stock will do well. Only issue with this company is that the valuations, the liquidity is very less in this company. Promoters were holding good chunk, and then 3 mutual funds also holding very good quality of this. The floating stock is very less, and that is why the volume will be very less in Nilkamal, and one can gradually buy it. The fourth company we are recommending is Care Rating. The rating business is doing well, because now the advances from banks are going up, which means that more bond issuance are happening, and economy is doing well, and more companies are getting loan, and because of that the rating business will do well, which will benefit Care Rating. The other 2 company, ICRA and CRISIL, apart from rating business, they have the other source of income in research related products, whereas the care rating, most of the income coming from rating business only, and we expect that the rating business will grow by 20% for next 2-3 years, which will benefit this company. ESOP India is a multinational company because of capex plan going up, capex happening in our country. This company, which is in a welding related business, they will get benefit. Valuation is relatively lower when compared to other companies in the same type of business, in the capex business. Trading at 48, though looks very high when compared to other MNCs, it is still relatively less. That is why we have recommended this company. So Dr. Reddy, Infosys, Nilkamal, Care Rating, ESOP India. These are the 5 companies we are recommending in the current meeting. And if you see the review, Mahanagar Gas did well in spite of very good results. Actually, after we recommended, the price went up, but now it has corrected sharply in spite of very good results. But other companies like Zydus Life did very well, achieved our target. Wonderla similarly achieved our target, did very well. L&T did very well. Apart from the current closing price, they are coming out with buyback at 3,000 rupees. Additionally, they have given 30 rupees dividend. And anyone who has bought last month, they would have been in a good profit. HCL Tech, we expect the company to do well. They have recently got an order. So overall, if you set aside Mahanagar Gas, overall stock has done well, and the overall portfolio has given near to 4.76% return, whereas Nifty has given 0.5% return.